Robert Thompson. Today we're going to be talking about one of the 4 C's that banks look at to determine whether or not you're credit worthy in their eyes for a home loan, and that's credit. Now, credit is going to be broken down into 3 parts. It's going to be your credit score, your credit history, and your monthly obligations. Now, your credit score, everybody knows about credit scores, and every bank and every loan program has certain requirements for credit score on their loan program. So you may be required to have a 660 for a program. If you don't have a 660, you don't qualify for that program. The bank's got to look elsewhere. Now, that credit score is supposed to reflect all of your credit report in one number. That's supposed to kind of boil down the whole thing, good and bad, and give you a number that represents your credit worthiness. So that's what a credit score is all about. Second thing is credit history. They're going to look at your line items on your credit report. So have you had a late payment on anything before? Was that late payment 30 days, 60 days, 90 days? Was it a mortgage or just a credit card? Do you have a foreclosure? Do you have a bankruptcy? All these things are your credit history. And again, loan programs are going to have certain requirements. They may not allow bankruptcies or foreclosures, or they may not allow any mortgage lates. But then again, they may. So the bank's got to put you into the right loan program based on what your credit history shows. The last thing is your monthly obligations. Now, each line on a credit report that is a current debt is going to have what the monthly payment is on that debt. So a car payment may be $400, and let's say a credit card's $100. Your total debt then would be $500. They're going to add that to your proposed loan amount. So the house you're trying to buy has principal, interest, taxes, and insurance, possibly homeowners association fees. Add all those together and combine them with your debts showing on your credit report to come up with your total debt per month. They're going to divide that by your total income per month, your gross income per month, to determine your debt to income ratio, which ties into your capacity, another one of the C's, to pay back the loan that they're giving you. So that's it right there. Credit score, credit history, and monthly obligations. That's what the credit's all about as far as the bank goes. Hope that made a little bit of sense in a very quick summary of the whole process. Robert Thompson, talk to you soon. Thank you.